There's been a lot of talk about the power of indexing, folks, and it's about how you can make money when the stock market goes up to a point and not lose money when the stock market goes down. Is it right for you? Well, check out this short video and we'll find out. I'm Ryan Wheels, host of the On the Money YouTube channel powered by Ally Wealth. If you like the content we're putting out, please hit the like button down below and also give us a subscribe as well. We'll keep updating when we put out more videos just like this one. All right, so power of indexing, what is it? All right, well, folks, there's these concepts out there, and it's in the form of something called a fixed index annuity or an index life insurance policy to where basically you get to make money when the market goes up and not lose money when the market goes down. And if you're like me, when I heard this for the very first time years and years ago, I go, wait a minute, that sounds too good to be true, right? Well, folks, the reality is it's not, but there's certainly some caveats that go along with it. For the first thing is you get to make money when the market goes up, but you don't lose money when the market goes down, but you're never going to get the same return the market does. So to get the benefits of growing your money in this type of strategy with safety of not losing money in down markets, you've got to give up something, and that is some upside potential. So what this shows you here is the stock market, being the S&P 500 index, going back from the year 2000 all the way up until the end of last year, where the index was down about 18%. And what you're going to see is the average annual return of that index is 6.26% on average. Now, that's over that entire period, 22 years. It does not factor in any fees whatsoever, all right, something to think about. And so it's a 6.26% average annual return. Well, you'll see this a lot on other channels, and maybe if you go to a workshop or a dinner seminar or something like that, they'll overlay this graph to show the power of making money when the market goes up but not losing money when the market goes down. And you'll see here with that type of strategy, you get to a 6.23% average annual return. And it looks really, really good because in these years the market was down 37% like 08-09, and the year in 18 when the market was down nearly 24% there. And then when the market was down 18% last year, you didn't lose any money. Oh, by the way, go back to 2001, 2, and 3, you don't lose any money either. So in the down markets, you don't lose. And that sounds really, really good. And it can work for you, but you've got to understand the other side of the boat. So in this strategy here, you're going to notice that we have this 11% here compared to when the market did 15.06%. This particular strategy is capped, meaning if the market goes up 15.06%, you're not going to get 15.06, you're going to get 11%. All right. Now, a lot of people go, well, Ryan, does the company who offers this program keep the difference, and that's somehow how they make their money? And the answer is that's not how it works at all. All right. So there's a couple things you have to understand here. First thing is you're not going to get all the upside, and you're limited in the upside potential in the form of a couple of things. One is called a cap. Again, I just explained what a cap was. In this situation, we're using a cap of 11%. If the market goes up 15%, you don't get 15, you're capped at 11%. The other way it's done is something called a participation rate, to where you get half of the market's return. So in this case, let's say we had a 50% par rate, participation rate, and the index does 15% here, okay? Well, you'll get half of the index return, so 7.5% will be your return that year, all right? Another way they do it is with a spread, okay? And where the spread works is maybe there's a 5% spread off the return, okay? And we call that a spread rate. I'll Google abbreviate spread. And so in this case, if the index goes up 15.06%, they take the first 5% off the top, and your account would earn 10.06%. So in all cases, you're never going to get 100% of the market returns. And again, you're not going to do that because you're never going to experience any market losses. All right. That does not mean that this program is without risk, because you could have put your money in something else and got a higher rate of return than 6.23% over the same time period, like the market, for instance. And there's other things you could have done as well. So there's always going to be opportunity cost no matter where you invest. All right, or opportunity risk. But the better question that we have to really get to is, Ryan, I understand what you're telling me, right? But how does this work? I mean, how is this not too good to be true? And what we've got to look at here, folks, is how this is working. So when you go out and put your money in these index products, like an index annuity or a or a index universal life insurance policy, the insurance company is taking your money and they're going out into the world and they're buying bonds with your money, all right? And that's what they do. And they hold these bonds to maturity. So let's just say that the insurance company takes, I don't know, call it $100,000 of your money, all right, and they go out and buy bonds with it. And let's assume that they're able to get a 6% yield in the bond portfolio. All right, so times 6% equals $6,000. All right, so basically what happens is the insurance company's got your money, they bought bonds with it, and there's $6,000 a year in interest there. Well, make no mistake about it, folks, the insurance company's in business to make money. So let's say that they take $4,000 and they put that in their pocket, and that is their profit and how they make money, all right? But the question here is, how do you make money, okay? Well, what they do is there's a remaining $2,000 in this equation, right? Because the bond portfolio pays 6%, right there, $6,000. They took $4,000 of the $6,000 and put it in their pocket, so that's $4,000 to them, leaving $2,000 for you, okay? Now, what they do is they go out and they find an index, all right? And the index maybe goes up and down like this over time, okay? It can be the S&P 500 index, it can be the Dow Jones. There's all kinds of manufactured indexes out there. Be very careful with those because they're back-tested in history, and sometimes they look really, really good in history, but they don't really, really perform well in current market environment. So be careful with those, all right? But to that end, let's just use this index, and we can call it the ABC index for just illustration purposes. So here's what happens. They take your money, the $2,000 of bond interest only, all right, and they buy a call option on this index. All right, so a call option is going to work like this. If the index goes up, that option has intrinsic value, okay? And it gets exponentially bigger than the $2,000, or it should, all right? And so if the index goes up, your option goes up in value and then is exercised, okay? So whatever gain you make is added to your account. So let's just say that in this scenario right here, we added plus, I don't know, call it $6,000 to our account. Well, now I've got $106,000 in our account, okay? So here's what happens next year. Next year, that bond interest is paid again, right? The insurance company keeps $4,000 for themselves. They put $2,000 in the kitty to buy another option for you. So they take that $2,000 and they buy the option right here, all right? It's a call option again. And if the index goes down in value, that option at the end of that 12-month period expires worthless. It has no value whatsoever. But guess what happens? Your money you put in your account plus your prior gains is still in your account. You still have $106,000 even though the stock market went down. The reason why that is, folks, this is the most important part of this video, is the reason why that is the only thing being put at risk each year is that bond interest. That's it. They're not putting your principal at risk. They're not putting your prior gains at risk. They're only putting that bond interest at risk. Now, let's say that we got here to this level and maybe we had a gut feeling that the bond market, that the stock market was going to go down next year. Well, you could have actually elected to have that $2,000 of interest credited to your account and got another $2,000 there and had a value of $108,000. Okay, now let's say the index did go down. We weren't in it because we elected to take our bond interest and add it to our account that year. All right, well, now that bond interest is paid the third year. Okay, we buy in right there that index. The index goes up in value and our account will go up in value. So folks, that is the methodology that backs up this indexing strategy we're talking about here, showing on the screen, is they're using the interest from the bond portfolio only the bond interest, to invest for you in a call option on an index. If that index goes up in value, that option is worth something. That value of that option is credited to your account. If the index goes down in value, the only thing that was put at risk is the bond interest, not your principal, not your prior gains. So it's a pretty cool system. If you understand how it works, it kind of gets rid of the too good to be true, because it's not too good to be true, folks. But it's never going to keep up with the stock market. If you put your money in something like this, you're going to see years like where we go? Right here, 21% return to the stock market, all right? And this thing did 9.54%. So you have to understand that to get the benefits of using this index, you're never going to get stock market-like returns in any capacity. You're going to give up some upside potential for the safety and protection of not losing money in a down market, all right? That's for some people. For some people, it's not. But nonetheless, this channel is all about providing education to you, all right? So you can make the decision for yourself. Well, I'm Ryan Willis, host of the On the Money YouTube channel powered by Allied Wealth. I truly hope you got some value out of today's video. If you like the content we're putting out, hit the like button down below. Also give us a subscribe as well, and we'll keep updating you when we put out more awesome content just like this one.